A 570% trading return by embracing losses. Hi, it's Charlie giving you Saturday's video. Now, for many of you, you'll know that I did the annual update on the trading challenge just this past week, and so the trading challenge is now up 570%. Now, as I've always said, when I do these challenges, and like this one, I'd have been happy if I say just if I was up 150% now after 3 years, that'd still be a 50% return per year, which is still phenomenal return in trading. So not gambling, not buying penny shares, not buying crypto tokens that might, of course, explode. We're talking about genuine trading on a genuine pot of money. So the account started at 20k, and now as of the update, it was at I think it was 128k is where it's at now. So anyway, what's the point of this video? Well, if I can encourage people as much as I can, don't worry about win rate. And I talk about this a lot in my videos here. Win rates is what newer traders I know obsess with. They want to be right. I know it's a general human trait. We want to be right as much as possible. But win rate a lot of the time doesn't produce these sorts of returns. So I could have a higher win rate and it'd be very easy for me to do. So the reason I have lots of losses is because I'm trying to run the trades. So when I get into trades, it starts running up. I don't track the stop. So if it just ends up rolling back over, I just get stopped out for a loss, because it's those few trades that end up going higher, a lot higher. They still might need me to not trail that stop up too aggressively. And if I trail the stop up too aggressively, then I end up getting stopped out and then miss those few big winners. So now, that's the style that I enjoy trading. As I've said over the years, trading for me nowadays, I've been doing this 26 years. It's more than just trying to make money. It's the mental challenge that I enjoy from trading. So getting into trades and actually trying to hold it for a given amount. I'll always have a target, but holding it for a given amount is where I get the enjoyment. I enjoy the mental stimulus from watching it going up and down and all the way around, and seeing some of them roll way back over, and you have to dust yourself down and move on to the next opportunity. But if you could just take some essences of this, you don't have to do what I do, but just trying to hold on to trades that little bit longer and get more R out of your trade, then it'll probably fare you better. Too much obsession about being right is responsible for people losing plenty of money in the markets. So I like to make the point here when I'm doing these challenges of saying, look how much you can make by having lots of losses. And the reason I have lots of losses is because like I said, I don't bank the profits that soon. And so I'm allowing many of these trades I get into to end up rolling over. So you don't have to go that far. But what I'm demonstrating is that you can make very good returns, exceedingly good returns, I believe, without having lots of wins, and just having those, in relative terms, a lower win rate. So when I'm talking about a lower win rate, what I'm talking about is lower than 50%, less than 50% win rate. Most of the world's traditional big hedge fund managers will have lower than a 50% win rate. The longer you hold on to your winners, the lower the win rate will be. So of course you have to find a balance between win rate and where you're comfortable, but somewhere south of 50% is probably where you want to be if you're looking for larger risk-reward ratio trades. I'm not saying that you have to be looking for 20R risk-reward ratio trades or 30 or whatever, but if you're looking for anything realistically 3R 3R or above, then it's likely your win rate is going to be less than 50%. Anyone who tells you that they have a 70% win rate and they make 3R on average is lying to you. I see the broker's figures. So anyway, you have to find that balance. So you might say, well, actually, I'd rather be sitting around the 50% or so, 50 to 60%, and actually just be at 2R, and I'm comfortable with that. That's absolutely fine. What my job is to do is just to show you what I do in order to get these exponential returns. So let's have a look at what else do I do. So there's a few things here. As far as the returns are concerned, I showed the spreadsheet, the broker statements there. Someone did ask, well, why didn't you put it on my FX book? Well, my FX book is full of crooks and it's highly manipulated. Just YouTube it and you'll see how easy it is for the crooks out there to manipulate numbers and make it look like they've got these amazing backtrack records when they haven't. So I'm not even going to bother putting myself onto there because it's corruptible in that regard. So no, if you really want to check me out, check out the fact that I'm on the FCA register. You don't get to be on the FCA register here in the UK unless you're a genuine trader and money manager. And also, by all means, check me out over at Pelican Trading. That's where my funds are. So there's not much more that there's nothing better you can get, more genuine that you can get than that. So the four things. Okay, there's four foundations to foundational elements to my trading. Okay, so and of course, so okay, let's go through them. So number one is multiple time frame analysis, MTA, multiple time frame analysis. So a top-down approach. So using higher time frames. I've got this on what's this on at the moment? Okay, so on the dollar index, actually it's on a weekly chart. So I wouldn't necessarily trade directly off a weekly time frame, but I will be using the weekly when I'm looking at any market. But I will start off at the higher time frame and work my way down. Most of the time I'm executing based on either the daily charts or actually the 4-hour charts or even the hourly charts. I'm actually executing based on what's going on those smaller time frames in relative terms, because I'm trying to get those ultra large, if I can, risk to reward ratio trades. But it's all based on the top-down approach. So I'm going out to the monthlies, the weeklies, then the dailies, and the quarterly charts as well. So I'll be looking at quarterlies, monthlies, weeklies, and then down to the dailies. So multiple time frame analysis is the first thing. And bear in mind, I am a lot of my trading is based on the dollar. Okay, so I'm trading euro dollar, which is basically an inversion of the dollar index. So I don't know the percentages, but 80% of my trading is on the euro dollar. So number two would be IMA, intermarket analysis. Okay, so if I'm trading the euro dollar, I want to see, well, what's the Australian dollar doing? What's the Kiwi dollar doing? What's the dollar yen doing? What's the pound dollar doing? So although I may be executing based on what the euro's doing, I'm still looking at the intermarket analysis to see, I want confluence amongst other currencies against the dollar as well. Not just that, I am interested in what gold might be doing, because obviously that's priced in dollars. The stock markets, they're all related to the dollar. The bond market as well. So intermarket analysis. So it's not as simple as just saying, oh, there's a pattern on the euro, I'm just going to go and trade it. Now, I will trade given strategies on the euro, but it's all interrelated to all that other analysis as well. Three, I've got all of these abbreviations today. MS, market sentiment. So market sentiment is an important one for me as well. Now, the interesting thing with market sentiment is there's not always going to be extremes in market sentiment. So ideally, I'm looking at times when there might be extremes in market sentiment in one direction or another. But it's not always there. And I use market sentiment in various ways. So I will look at what retail traders are doing, but what retail traders are generally doing is if a market's going up, then they are shorting it, and if a market's going down, they're usually buying it. Why? Because they're morons, like I've said in one of my previous videos. And I don't mean it on a personal level, I just mean it's just a term of endearment. But yeah, because it's a natural thing, especially with newer retail traders who might have been trading a couple of years or whatever. And if they've not really gone into the technicals too much, they see a market going up and they think, oh, it can't go much higher, my stochastic's overbought sort of thing, and they start selling it. So they trade a lot on gut instinct. So, but I will look at what retail are doing. I also want to look at what the big players are doing. So I'll look at what the hedge funds are doing, and I can get that information from the COT reports. Then I want to have a look and see what Reuters are saying and what Bloomberg are saying and all of that, and the big publications, the Economist magazine, you name it. Now, at times they're not coming out with front page headlines every day or every week. So, like I said, there aren't always extremes, but you do get to points in time when there are. And so headlines in financial articles are really important as well, amongst others. And then I will go across social media, just picking up the overall broader sense of sentiment as well. There are other sentiment measures outside of that, of course. When in relation to the stock market, there are always regular surveys that go on in the stock market. For example, the American Association of Individual Investors, of course, that's a broader sentiment measure of what investors are thinking in relation to the market, but there's so many more. So sentiment plays a part in the trading as well. And then, of course, lastly, we've got the, I might as well keep this all abbreviated here, FA, fundamental analysis. So, and what I'm talking about within that, when I say fundamental analysis, I'm talking about what's coming out in the news. So what's the data like coming out of, and bearing in mind I'm trading the US a lot, so I am US bias. So what's the data coming out of the US like? So for example, yesterday, I'm recording this on a Saturday, yesterday we had PMIs out of the US. So their services PMIs came out slightly higher than expected, but the manufacturing came in slightly lower than expected. But we do know that it's a larger service economy than manufacturing. But so it was a mixed report. But then we've just had FOMC earlier in the week. What was Powell saying? So all of that comes under the fundamental analysis as well. And I will take that into consideration in relation to everything as well. Most of the time, though, the fundamentals probably play funnily enough, they do play a big part, because we're constantly looking at what's the next news event that's coming, which could move the markets one way or another. So they are a big factor. But what I mean, will they stop me from taking a trade? No. If my multiple time frame analysis is telling me to be long overall, and my intermarket analysis is telling me to be long overall, the sentiment is, not always going to be, there's not always going to be extremes or anything like that. Oh, the other thing that I've missed off here is the strategies as well, the entry techniques. So I've got certain strategies, of course, to get me into the market. So I'll be looking at certain entry techniques that I use for entering. But what you can see is the strategies I've put right away down here. All right, maybe they shouldn't come fifth, maybe they'd come fourth, I don't know. But the analysis, all of this stuff comes in first, and then the strategies come in afterwards. Whereas most retail traders are obsessed with strategies. Right, find me a strategy, give me a strategy, and I'll just trade the strategy. So, and of course, probably the biggest one of all this, which I'm also missing off, we get a 6 point now, is what? The mindset. But the mindset is the biggest factor of everything. But and that's what really makes you your money. But in order to take a trade, yes, I need to have mindset, of course. but I need all this other stuff going on. But if I could put it all into an overview here, these are the things that I'm using on a day-to-day, week-to-week, month-to-month basis in order for me to take trades. Now, the mindset is the biggest thing, because if I've got a low win rate of, let's say, I don't know, whatever it is. I mean, it varies. Let's just say 30%. It might be a bit more than that. At times, it'll be less than that. It's the mindset that helps you brush it off when you just go and have a few, a number of losers in a row or losing period. It's the mindset that helps you brush it off when you've been in a nice profitable trade and it rolls back over. And an average retail trader will be like, woeing, the fact that they've missed out on banking all that profit and it's rolled over, and I'm never doing that again, and all that type of stuff. So the mindset's the most important thing at the end of it all, which is really what makes you the money, because it keeps you level-headed if you work on that. But you still need all the technicals and all of that as well. So there you go. So there's a little bit there on all the things that I do. So I'm going to carry on with the trading challenge. One thing I didn't say in the week was, I think I might have done actually, that the overall goal for that challenge account is to get, I don't know, is to see if I can get it to 1 million. Now, I don't know if I'm going to be able to get it to 1 million. Oh, and that was in the next 5 years, I think. That seems pretty punchy, but then to get 20k into 128k and deliver a 500 and something % return in 3 years is pretty punchy as well. So can I do 128,000 into 1 million in 5 years? Who knows? You just don't know what the market's going to present me. And so all I do at the end of the day is focus on the trading and on the process. Now, coming back to it all, where I was at the beginning, and for those of you who are still watching this, if you can move away from obsessing about being right and think about overall profitability, then it will put you in a good position. I'm not saying that the way that like I said, the way that I trade is going to be right for everyone. It really is the road less traveled, but I like that for the very reason that it's the road less traveled. The masses wouldn't like the way that I trade because they need that. Oh, I need a winner. I need a winner. I need a winner. I can't be bothered to bank profits once I'm into profit. I want to hold it. I want to run it. I want to build it. And so that's not the way that I'm going to trade. But the funny thing is, over time and time again, it seems to work its way out. And so maybe take a little bit of what I'm talking about here today and see what you can apply into your own trading. I hope today's longer video has been of interest to you. Have a lovely weekend. I'll see you next week. And by all means, give us some comments if you got anything you want to add.